Germany's GDP quarter-on-quarter data released today remains unchanged at 0.3%, loading more pressure onto the Eurozone crisis as even Germany struggles to bring in higher GDP figures. Joining me now to discuss this further is Chris Parkinson, Head of Credit Equity Research at Christopher Street Capital. Hello, Chris. German GDP quarter-on-quarter data is showing today as unchanged at 0.3%. What do you think this tells us about the euro crisis?
Yeah, I think German growth is obviously still a reasonable positive for the broader European economy. Though we are seeing a slowdown in growth in the region, and also the breakdown of what is driving that growth is leading me to have some concerns. If you look at the breakdown of the figures released today, you've got strong growth in net exports to non-euro denominated regions and decent private consumption, but investments, capital spend down quarter on quarter, which to me suggests the euro crisis in the periphery of the eurozone is starting to hit core Europe. My main concern, particularly, is with capital investments decreasing. Suggests to me that the German manufacturing powerhouse is starting to become significantly more concerned about the outlook for the rest of 2012. I think this is backed up by if you look at the flash PMI data just for July and for August, it does suggest that the second half of this year is not going to paint such a positive picture for Germany.
And the Euro Q2 GDP data last showed a decline of 0.2% despite Germany's growth. What do you think this tells us about the Euro crisis now?
Yeah, I think consensus is very much that by the end of Q3 we'll have the eurozone or will show the eurozone in recession again. I'm afraid to say that the GDP numbers from Germany certainly don't suggest that the strength of the German economy is enough to keep the region out of recession. And if anything, the recent PMI readings suggest that German economic growth is waning and coming back to the European norm rather than dragging the European up to German standards. So I think we will see the eurozone in recession by the end of Q3.
So, Chris, economists are now saying there is a likely chance of a decline in Q3 due to big budget cuts, high interest rates, and sovereign debt rising. What are your thoughts? Could they be right?
I think they can most definitely be right. Absolutely. If you look at all the early business surveys for Q3, that's certainly not challenged any expectations that there's going to be a decline in GDP for the eurozone this quarter, which would obviously put the eurozone back into recession. I think there's an interesting dynamic going on at the moment between core Europe, particularly Germany and German growth, and the eurozone periphery. And I think if you look back to say the beginning of the year, there was very much a general consensus that there would be moderate growth in Europe for the year, driven by a strong German economy. Whereas now, I think what's more likely to happen is that the euro crisis in the European periphery is going to drag Germany back. I don't think we're going to be talking about a German recession, but I don't think that the German economy is going to be able to stave off another recession for Europe in general. And if you look at the composite PMIs for Europe in general, just over the last couple of quarters, I think that's pretty consistent with GDP falling in Q3 by about 0.5%. So that means that we're going to have to see a pretty significant pickup in September for growth to get above zero.
And what do you think Germany can do to boost growth now?
Well, I think we're not looking just at Germany, but we've got to look at a sort of broad European and if not global global process to drive growth in Europe, and this is not something that is going to happen overnight. My projection for risk assets over the next couple of quarters, very much depends on a pretty packed political agenda over the next month. And there's going to be an awful lot of policy response, not just from Europe, but also from the Fed, to help drag Europe out of its economic slump. I think the key things that we're looking at really are, first of all, you've got the symposium at Jackson Hole with Bernanke and Mario Draghi both speaking, and the key things here will be any indications on further quantitative easing, not just from the Fed, but also from the EU. Now at the beginning of the summer period, Draghi certainly did make a big step forward in improving investors' appetites towards risk by announcing the conditional government bond purchase program. Now this announcement has probably helped to inflate risk assets throughout the summer. And what's been a pretty quiet August as far as any policy announcements have gone, suggesting that maybe risk assets have run too far without any really firm action from the ECB or from the European governments. But we would certainly be looking for further details on that to sort of help improve risk sentiment, shall we say, and to help sort of drive risk assets further. Without any meat on those bones, then I fear that that investors are going to start becoming slightly more concerned that this lick and a promise from Mario Draghi and limited follow through is not going to help drive any economic growth. So, and I think what we're looking for is ECB monetary policy to add liquidity to the European economy, and really sort of bide or give more time for the European periphery to start getting their houses in order. If you look at the fiscal policies in place in Spain and in Italy, these are not policies that will see a turnaround in growth in the very short term. These are long-term fiscal austerity policies that will take quarters, if not years, to yield results. And initially, what we need is we need time from the ECB, time from the IMF to allow those policies to take place. But I fear in the short term we're not going to see any pickup in growth. Certainly not for Q3, and probably not for Q4.
Thanks for joining me, Chris. Well, that's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews from the TV team. For now, though, goodbye.